I am going to explain you in this video how you can make money in a market that is actually going down. We will go over the fundamentals of short selling and I will teach you my strategy that I use and that also you can use as well when you're day trading. Beginner friendly, so stay tuned. So, how do you make money when the market is actually going down? In 2020 and 2021, it was actually quite a taboo topic. Everything in the market seemed to go up, the markets were roaring and soaring, the raging bulls were on, and it was very not common and very unpopular if you were trying to short the market at the time. Everybody crazy and everybody going to the moon. Until 2022 happened. And here we are, most markets have declined over 50% and there we are. As a trader, you have to acknowledge the fact that everything that goes up must come down at some point. And boy, did we have a sell-off during 2022. So, what do you do when buying low and selling high doesn't simply work anymore? Simple! Reverse your strategy. This is where you can choose to short an asset and actually sell high and buy low. So what is short selling exactly? Now, I'm going to use a real life example. Personally, I am a really big fan of playing video games and collecting them and collecting game consoles, etc. It's a hobby and I'm just truly passionate about. So imagine you are playing a video game that you have a blast, you have a blast in playing. You just really enjoy the game, and after you've experienced the game, you really become a fan of the game. And you collect items from the game, maybe an art book, maybe some action figures, and of course when a second part comes out, you're also going to buy that. And in addition to that, you actually become a fan of the studio that created that video game that gave you such a pleasant experience. When you are looking at the markets and you have trust in that company, you decide to buy some stock because you truly believe that this company is going to do well in the future. This is one prime example of buying potentially low and eventually selling high. Now, let's imagine a different kind of experience. You have been playing these kind of video games and you have been collecting items from this particular company for a while. But over time, you start to realize that your experience that you're having with playing these video games that come out afterwards are starting to decrease a little bit. They are starting to, you can see that they become a little bit lazy. The animations are not right anymore. They seem to be using the same maps and they seem to be using the same formula, and the game simply becomes boring. Now, this is a totally different experience, and you are going to think that from that moment on, if the company is going to continue to create games like that, then it might not be good for the future of the company. That changes your stance on the company, and what you can do then, you think that is bad for the business that they're running, so you think the company is going to get down in value. That is when you can decide to short the stock of the company on the open market, and then if you are right, this is how you can actually create some profits. Another way to learn how to short, for example, is of course take a look at your old self or when you started trading. I will use myself as an example. When I was still learning how to trade, I would always buy right at the top and only to just be in profits just for a little bit. Then the market would just tank down and I would be holding those beautiful bags. Good old times. So then I thought, how about if I just do the opposite of what I'm thinking? And instead of buying high and selling low, I would sell high and buy low instead. So how does shorting actually work? Well, most trading platforms do not really have a shorting option. That is why most platforms you need to actually sell an asset in order to get into the short and use your buy button to close your short trade in order to collect your profits. But wait, what? How can I actually sell something that I don't actually own? Aha, that is a very good question. You see, it works like this. Very simply put, you sell high and you buy low. You have to borrow shares from your broker or exchange. You sell them at the current price on the open market. And then, when the price has fallen, you buy those shares that you have originally sold, you buy them back at a lower price, you return that what you've borrowed back to your lender, and the difference in price that you paid for it, that is the profit that you can just stick in your pocket, and that is yours. Does that make sense to you? Okay, let me illustrate with an actual realistic example. Let's say you're trading Bitcoin. Let's say you want to short $10,000 worth of Bitcoin at $10,000, which is the current price. Price falls to $5,000, meaning that it actually decreases 50% in price. That will be the point where I would buy back my 10,000 contracts that I originally shorted for half the price that I originally sold them for. Then I give back those 10,000 contracts back to my lender, and because I bought them back at half the price, I have now made $5,000, and those are now my profits. So with shorting in trading, there's always risks involved, as with anything in trading. But now we're talking about shorts, so let's talk about the potential risks that shorting can have. Shorting has always limited downside potential, whereas upside potential is always pretty much unlimited. You see, because a price can only decrease by a maximum of 100% to zero, theoretically. Most of the time that doesn't happen, but that is the absolute limit that you can get out of a declining market, a 100% decrease in price from its all-time high. On the long side, the limit is actually unlimited, because a price can increase by far more than 100%. 200%, 300%, and in crypto, let's be honest, it can even be way, way, way higher. So it is important that you are aware of that at the very least. Another risk is, especially after an asset has gone down for a significant percentage and a significant amount of time already, the danger is there for a potential short squeeze. Now, a short squeeze means that after the market has gone down for a while, it can be very possible that new buying interest suddenly comes into the market, and that pushes price up way beyond the original entry price where shorters have gotten into that. So they are actually forced to close their positions due to that new buying interest, and that is how a short squeeze can arise, making up for very volatile price action. That is definitely a risk that I would recommend being aware of and definitely taking care of. And the longer a downtrend usually continues, the higher the chance of new buying interest being attracted to push the market again upwards in order to hit the stop losses, or forcing people to close their short positions that have shorted in a relatively late moment. So how do we use this information to actually trade from? Let's move over to the computer. So we have arrived at the battle station right now, and I want to explain to you how I would be trading a short bounce. But first, I want to mention one important key factor that is extremely important: how to recognize weakness or strength in the market. And that has to do everything with volume. Now, when you are looking at a strong trend, you would be seeing increases in price, and of course we will have retracements during that time. But the trend then continues on and on and on. And typically what you would like to see, volume is actually explaining the narrative of the strength or weakness of that particular trend. So what you typically want to see in a healthy trend, in this case an uptrend, you want to see an increase in price, and you want to see that accompanied with, let's say, an increase in volume, which happened over here. We see a rise in price and an increase in volume. And then on that retracement, or in other words, a consolidation period, you see a drop off in volume, as you can see over here. After which simply the strength continues with more volume, and then once again on the next consolidation period you see another drop off in volume once again. Then another increase in price, you see another increase in volume, etc, etc, etc. Now at some point every trend obviously comes to an end. However, this is a prime example of a relatively strong trend. Ultimately, we did hit resistance at some point, after which we saw a total reversal and make a lower low in the end on the chart. However, this is the nature of a relatively strong trend. Now, let us move over and let me show you a different example where the opposite is actually true. This is Bitcoin in the end of 2021 and the beginning of 2022. We see a really big decline in price, after which we see a really big bounce over the course of a few months. So this is not necessarily a lower time frame retracement, but it illustrates the idea of volume really well. And as a matter of fact, we have something what we call a dead cat bounce here. And that is the strategy that I want to explain in this example. And fun fact though, animals in trading are very common to use, and this is what we would call a dead cat bounce. And it derives from the idea that anything can bounce if it falls from a great height, even a dead cat. Now in the market, this shows that after falling from a really great height, anything ultimately can and will bounce. However, it is not necessarily a sign of strength, but it is rather just a bounce after which the trend ultimately continues. And that is exactly what we would see over here. So allow me to demonstrate. So after falling from a really great height, we do see a really big bounce that eventually evolved into a much larger bounce. But remember what I just said about the volume. In this example, the volume does not increase at all. As a matter of fact, it actually flatlines. And that means that there is really no volume backing up the move. So rather than saying that there's strength in this move, you could actually say that what I mentioned before earlier in this video, that this was actually part of a short squeeze, after which we saw another retracement, and only to discover that that short squeeze was not done, and we had yet another one straight into a very important resistance level that revolves around this strategy, the dead cat bounce, which is where we can use Fibonacci. If you're looking for a dead cat bounce, the 0.382 level is extremely important. If we pull a Fibonacci level from the all-time high on Bitcoin, which was at $69,000, all the way to that particular low point, if we pull Fibonacci from there, we can see that we actually hit that level, and we hit that level, we overshot it more or less a little bit, but this is what I would call a failed breakout. We breached the level on weakness because there's very little increase in volume overall if you compare it to the entire move, after which we tried to breach the level, but we failed to do so. We fall back through the level, we backtest that actually as resistance, marking the end of this dead cat bounce, and overall the entire trend continues to go down. This is the dead cat bounce strategy that you can sell short in a bear market. Now, I do want to highlight two bonus tips that I want to give. This strategy is particularly useful after a failed breakout. For example, you breach the level, but you fail to hold the level, and then you actually dive back under the level, after which you have your opportunity to short the continuation of the trend. A second bonus tip that I want to give, that even though the chart might show weakness as we are trading into support, this was at the time a very big support level, never short weakness into support. What do I mean with that? I mean with that during this move, this was a sign of weakness. However, because there is support over here, this is very dangerous, because these are usually the places where a short squeeze can be initiated. So what I would always recommend doing is to wait for the bounce and then look to trade the chart short. Now, if you find yourself often in the situation that you are right on the direction of the price, you get into the trade, but you get stopped out quite a bit, then watch this video over here. If you enjoyed this video, then leave a like and subscribe.